Hello, viewers. How are you? So, today's topic is about housing affordability. So, what does it mean by housing affordability? It means that when interest rate changes and when the price of the house changes and also your income changes, then how much value for the house you can afford. So how much mortgage payment or how much proportion of your income you would be paying towards your mortgage. So for those who are planning to buy a house and who have delayed or deferred their decision to buy a house when there was a housing bubble in Canada, this video is especially interesting for them. Viewers, as you know, there is a trend of increasing interest rates. Central banks are aggressive towards raising their interest rates. We are at a higher interest rate era now. Even lots of financial advisors are saying that this rate increase will continue up until at least 2023. And also they think that it might lead to a recession. So the question comes that it comes in my mind is that if interest rates are high, and those potential buyers who did not buy the house before the rising interest rates, like the time when the interest rates were low, although the prices were very high, are they better off buying at a higher interest rate or not? So how would we see? We have seen that the housing prices for a small townhouse, 3 bedroom, 2,000 square feet, the price was around $750,000 before the increase in the interest rates during the COVID-19 period. The same house now is available at 100,000 less price, $650,000. But in the era of low interest rates, although the price was $750,000 for the small house, but still the interest rates were around 2%. Today, the interest rate is close to 5%. So we want to see the potential buyer who did not buy their house at a low interest rate time, are they better off by saving $100,000 in the price of the house, or they are not? So for the sake of comparison, what I did, I looked into two different scenarios. Scenario one is for a person whose income is $80,000 a year, of 1 year. He makes around $80,000 a year. And he was planning to buy a townhouse of small townhouse of 2,000 square feet, price at $750,000 when the interest rates were low. And at that time, just for calculation, I assumed that when the rates were low, so the interest was 2%. So at that point in time, that potential buyer, if he would have bought the house at 2% interest rate, although he would have paid $750,000 for the house, his monthly payment would be $3,175. Now consider the second scenario. Same person, his income has not changed because it's only a matter of few months, and the same person having the same income, $80,000, is now buying same house which was available at $750,000 before, now available at $650,000, $100,000 less than the previous price. But because the interest rates have gone up, so the mortgage rate is not anymore at 2%, but the mortgage rate is now at 5%. So we want to see how much will be the monthly mortgage payment for that person. Doing the same calculation, we find that at a $650,000 maturity of the mortgage, if we continue same at 25 years as we had it before, the monthly mortgage payment for $650,000 house would be $3,780. So there is a big difference. In other words, what I would do now is I would see, okay, so how much proportion of the income this person would be paying today compared to yesterday. So let's see how to calculate the affordability or the proportion of the income. Whatever is the mortgage payment of the house, monthly mortgage payment, multiply it by 12. So that would be your yearly mortgage cost. Divide that mortgage cost by your income of the annual income. So that would be your proportion of income spent on mortgage rates. Okay, at 5% interest rate, since the and at a 650,000 house price, a potential buyer would be paying a monthly mortgage of 3,780, which turns out to be $45,360 per year mortgage payment. Divided by the salary of the person, 80,000 per year. So I get a proportion of income spent on mortgage is 56.7%. Now compare the other scenario, which was in the past when the price of the house was $750,000, but the mortgage payment at 2% was $3,175. So $3,175 times 12 turns out to be $38,100. Divide this number by $80,000 salary. The proportion of income the potential buyer would have spent if he would have bought at 2% interest rate was 47.6%. So today, if a potential buyer buying a house at 100,000 less price, his affordability index is down by 9 percentage points. In other words, he is losing $7,260 per year over the next 5 years if he buys today the house at 5%. So the question comes, will the price further go down of the house? Yes, in order to match this loss, the prices have to go down further, and potential buyers should have to wait a little bit more while the price may settle. Okay, there is one more scenario that needs to be identified here is that when banks they approve a buyer for the mortgage, they look at how much the proportion of income a person would be spending on the mortgage payments. So the first scenario where the price of the house was $750,000, we assume that the buyer had no other costs, no other borrowings, no other loans to pay. So that's why he was spending 46%. So 46% is normally is a figure that banks normally look at to approve the mortgage for that much of amount. Now, in the second scenario where the price of the house has gone down by $100,000, but you have seen that the proportion of income spent on the mortgage has gone up to 57%. So now the problem is that bank even would be reluctant to offer this potential buyer at the same income of 80,000 a mortgage for $650,000. So this person is even worse off because he cannot even afford to buy, because affordability index or the proportion of income spent on the mortgage payment, normally banks say they should not exceed 46%. So what is good for the buyer now? If the buyer wants to buy, he might have to wait a bit further so that the prices may go down further. So to bring it to the price of $500,000 price for the house, that where he would again go back to 46% of his income spent on mortgage. So the question then comes that do we expect that a house that was being sold for $750,000 would come down to $500,000? It had already gone down by $100,000. This is food for thought. But one thing also is very hard to speculate what would be the future in 5 years. It's quite possible that this higher interest rates may lead to deep recession, and then central banks start declining their interest rates, and that would improve the mortgage affordability for potential buyers. Many things can happen. But at the moment, with the given scenarios, I was comparing just two scenarios: higher interest rate lower interest rate, higher mortgage payments, lower mortgage payments, higher house price, lower house price. So food for thought. We'll continue discussion about this housing market as the things change. Till next video, have a great day. Bye bye.